So today, these are the things we're going to talk about: why you should invest, the different investment options that you have. We're going to talk about starting early, where to start from, investing for retirement, developing smart tax strategy, protecting your investment, setting realistic goals, performance by asset class, how to achieve success, and then I'm just going to uh, introduce you to, at the end of the day, to Ivorian Financial. So let's dive in. So why should you invest? There are so many reasons why you may want to invest. And the first thing is to build wealth over time. When you see the millionaires or billionaires that we see around us, none of them actually stumbled into wealth. Well, maybe there are a few ones that were born into wealth, but even if you are born into wealth, for you to sustain it, you still need to learn more about investment. So basically, investing is a very powerful tool for building wealth and achieving long-term financial goals. When you invest in different assets, stocks, and some other things that I'm going to talk about today, your money has the potential to grow through return and compounding interest. So, and because of that, even so, I'm not going to lie to you. There are risks, and we are going to talk about risks with investment, right? But even with the risk, investment still offers a lot of opportunities and higher reward. Compared to maybe just putting your money in the bank, or just putting your money in an envelope in the house or something. There are just uh, so many rewards with building wealth. The other reason is you want to build what's it called? You want to beat inflation. Now, what many people do not understand about putting money in the bank is that more often than not, the money you have in the bank is losing its value. People don't understand that. Let's say, for instance, you put $1,000 in the bank. 1 year later, you still have 1,000. But 1,000 that you have right now is not worth the same thing it was worth a year ago, because there's inflation. And most of the time, when you have savings account, an average savings account will give you a return of less than 1%. That is way lower than the 12 months inflation rate in the United States, right? So your money that you have in the in the savings account is losing money. In order to make sure you beat inflation, you want to invest. Now, apart from that, another reason to invest is to achieve goals. You may have different goals. Maybe you want to go on vacation. Maybe you are planning for education. Maybe it's you want to get a house or something, your first home. You may want to invest so that you can achieve that goal. Your money grows so that you can achieve that goal faster than you would normally do if you put your money in a savings account. Then the last thing I have here is to enjoy financial freedom. What is financial freedom? You have financial freedom when you are able to achieve your goal without any stress, without any financial stress. This is what I mean. Let's say you want to go on vacation. You need, like, let's say, if $5,000 to go on the vacation. When you have financial freedom, you will not have to take extra shift just to make more money to go on that vacation, right? And when you have financial freedom, you'll be able to, let's say you need something now, you'll be able to afford what you need without having to borrow, without having to take extra shift. That is financial freedom. Financial freedom is like you are able to enjoy, you are comfortable, you know. So when you invest, you are able to, you'll be able to have financial freedom. Now, having said that, there are so many investment options available. This list that I have is not exhaustive. There are so many other investment options that are available, but these are some of the most common ones. Number one is stock. When I talk about stocks, I mean regular stocks, I mean ETF. ETF stands for exchange traded funds. I mean mutual funds. I mean index funds. When you try, and that's the main thing I'm going to be talking about today. Everything I'm going to, starting from this slide, everything I'm going to talk about hinges on investment in stocks. And please, if you cannot hear me very well, let me know. If sometimes my voice is so low, so if for any reason you cannot hear me very well, please let me know. Now, the other thing is real estate. And real estate could be residential real estate, it could be commercial real estate. There's another class of investment that I'm not even sure if I should put it under stocks or under real estate, and that is called REIT, Real Estate Investment Trust. Real Estate Investment Trust. The reason I'm not sure where to put it is that under normal circumstances, it should be under real estate. But now, majority of REIT are traded on the stock exchange. So if you want, you can put that as part of stock as well. So that's something else you can invest in. Another thing, you can invest in gold. And not just gold, precious metals generally, gold, silver, and some other things that you can invest in. Bonds. It could be commercial bonds, it could be municipal bonds, it could be treasuries. Those are the things. There are some of them that you can buy in the primary market. There are some that, okay, you can only get them in the secondary market. But yeah, you are still able to invest in them. There's another category of investment is called CD. CD stands for Certificate of Deposit. And when I talk about CD here, I also mean I'm not just talking about CD itself. I'm also talking about share certificate. Share certificate is similar to CD. The main difference between share certificate and CD is that CDs can be obtained from banks or like brokerage firms, while share certificates can be obtained from credit union. So those are some other things you can invest on. Also cryptos, Bitcoin, and some other things, you can invest in them as well. Now, one thing you may want to note about gold or maybe general precious metals and cryptos is that you can invest in them directly or indirectly. That's just what I mean. You can literally purchase gold or any other precious metal, and you can also purchase cryptos. But an indirect way of owning them is when you buy the stocks of a business that actually um, trades or transacts in those commodities. Like, for instance, I have gold ETFs. When I buy gold ETFs, some of the companies that I invest in actually deal with gold directly. So rather than me buying gold, if I buy gold, I have to store it. I have to make sure that it doesn't get stolen. But rather than doing that, I buy ETFs of gold companies. So in that way, I don't have to deal with security. It's the same thing with cryptos. I know cryptos are very, very volatile. And for now, I'm not able to take the risk. I don't own any crypto. But rather than that, I also buy crypto ETFs that I am more comfortable with. So that's one thing you can note about us. Then, starting early, the power of time. This is something that so many people get wrong. I hear people say, oh, I'm going to start investing tomorrow. I'm going to start investing next week and all of those things. They are just pushing it to the future. Some people will even tell you that, okay, I want to invest more money. Maybe I want to start with $5,000, for instance. And they say, okay, I don't have the money now. I'm just going to wait until I have more money and then I will invest. What they don't understand is that what is more important is the consistency and the power of time. That is more important than the value that they actually invest. This is what I mean. It's better to start investing, maybe start with even as little as $50 and start today than waiting till next year when you might have $5,000. And the reason is because of the power of compounding. What do I mean by compounding? When you invest, your investment grows gradually. And in terms of the capital growth, and also sometimes you get dividends, sometimes you get interest on your investment. Now, the way compounding works is this. Let's say, for instance, you invest $100 in in a particular asset. The $100, let's say after 6 months, the $100 return, let's say $20. Now you have 120. When you keep your return in the same investment, the next time your return will now be based on, does anybody have a question? Okay. So when you start with $100, right? And then you make a return of $20. Now you have 200. For the next 6 months or for the next 1 year, your return will no longer be based on the original $100 investment. Your return will not be based on the 120 that you have right now. So basically, when I talk about compounding, it means that your interest in turn gets interest. And that's how you're able to get like exponential return from investing. So it's always better to start early, and this is especially good for maybe people who are still in college or people who just graduated from college. Don't wait until you start earning 6 figures before you start investing. Start investing immediately. You know, I had the opportunity when I was still in school. I had an internship and as an intern, my company let me invest in their retirement account. That was really, really good for me, you know. So if you are still a student, you have that kind of opportunity, please make use of it, you know. Our early financial habit helps you to build discipline. Apart from just the return you get from it, it helps you to build this discipline. You avoid debt, and you stay ahead of other people when you are able to when you start investing early. Now, there's one thing some people don't get right. Some people will just attend maybe a seminar like this and that talks about investing, and they just start to invest when they still have debt, when they don't have emergency saving. No. There are prerequisites that you should have before you start investing. The first thing you want to make sure you have is emergency saving. The recommendation is that you have between 3 to 6 months of expenses in emergency saving. Anything can happen. You can be going on the way and you have a punctured tire. If you don't have money, you have to go use your credit card. You go into debt, right? But you should have emergency savings. Now, when I said the recommendation is 3 to 6 months of expenses, it depends on your family situation. Let's say you are in a family, there are two incomes, right? Both the husband and wife have incomes. In a case like that, maybe 3 months of expenses is enough for your emergency savings. But in a case where there's only one income, you want to make sure that you have up to 6 months of expenses in emergency savings. Just in case something happens, just in case, God forbid, that you lose your job. You shouldn't have to starve because you don't have a job, you know, or you shouldn't have to go borrow or maybe go to food bank or whatever when you have emergency savings. And it's not necessarily limited to 6 months of expenses. If you have the ability to have more than 6 months of expenses, That's actually good. But to start with, you should have 3 to 6 months. That doesn't mean that, okay, if the only thing you can afford right now is 1 month, you should not have it. You should not have emergency savings. Start where you are, but gradually grow it until you have 3 to 6 months. That's when you know that, okay, whatever comes on your way, you are good. Then the other thing is debt payoff. You don't want to, and I put it in quote. I'm going to talk more about it. For an average person, you want to make sure that you pay off your debt before you start to invest. I'm going to talk about shortly when it might make sense to invest before you pay off everything. And the reason is this: if you have debt and you go start investing, maybe the return you are getting from the investment is not even up to the interest you are paying on your debt. You are losing money. And apart from that, I don't know of other people, but for me, if I owe money, it's got to go somewhere with money. It's just going to always be on my mind. When you clear off your debt, you pay off your debts, you don't have any debt, there's this peace of mind that you have, So it's very essential that you manage your debt very well. And if you go, I have a YouTube channel, go on, search for Ivorian Financial on YouTube. I have a video on debt management, where I explain different ways to manage debt. It's also on my website. If you go on the blog on my website, you'll see that. So it's important to prioritize payment on debt and before you start investing, especially debt like consumer debt, maybe credit card, and some other debts. It might be, it's always better. And also another thing is that when you don't have debt, when you pay off, you improve your credit score. There are so many things you want to do today that before you can do them, they pull your credit. And if you don't have good credit, you will either not be able to do it or you pay more. Even jobs, there are just some jobs. I used to have a job that before I got the job, they put my credit because it had to do with me seeing credit card details and all of those things. So there are things that if you don't have good credit, you might not be able to do. Now, having said that, there might be a few times that you may want to invest and still have debt. And let me share an example. Before you practice this, make sure you do your due diligence. I had a car note and I chose not to pay it off. The reason I chose not to pay it off is this. When I got the car, I wanted to pay it off fast, so I created an investment account for it. I put some money on it so that, okay, it will grow faster and I'll be able to pay it off. But then I discovered that the return I was getting from that account is way more than the interest I'm paying on that car note, right? So yeah, I chose not to pay it off. I chose to rather be paying that interest and getting the return. So again, before you practice this, make sure you do your diligence. It doesn't always work well every time. Make sure you compare, you do the necessary thing before you do that. And then when you have emergency savings, you've paid off your debt, then you can start to invest. Investment for retirement. Have you ever walked into Walmart and you were greeted by an elderly man or woman? Maybe there have been times that you know that, okay, this person is probably in their late 70s or early 80s. Quite all right. There can be some of them that the reason they are working there is because they don't want to they just want to go out of their own. They want to have something to do so that they don't get bored. But there are still people that the only reason they do it is they need to sustain themselves. They don't have enough income to sustain themselves. Let me tell you, Social Security, it's not everybody that qualifies for Social Security income. And even if you do qualify, Social Security would most likely never be enough to sustain you. So you must have other means of sustaining yourself and your family in retirement. That's why the place where you want to start when it comes to investing is having a retirement account. Now, if you have a job, there's a good chance that your job will have a retirement account, be it 401k, 403b, 457, and so on. So you want to make sure that you invest. And I want to beg everyone that is listening to me right now, if you don't have a retirement account, please go start it. It's very, very important. Now, when you start a retirement account, there are some companies that actually match it. Some companies will tell you that, oh, they match the first let's say 2%, 3%, 4%. I used to work for a company that matched up to 6%. That's one place where some people actually fail. Some people don't contribute enough to get all the company matching. And what it means is that you are literally either throwing money away or just leaving money on the table. That is free money that can help your retirement account to grow really well or grow faster. So make sure that you contribute enough to be able to get all of your company matching. Now, for some people that maybe what's it called? Maybe your company does not have retirement account, or maybe you are self-employed. There are some other opportunities for you to have retirement account. There's something called IRA, individual retirement account. You can open that with any brokerage firm. If you are self-employed, you can have solo 401k. You can have SEP IRA. Those are also good. So the fact that your company does not have is not an excuse to not have a retirement account. But one thing you need to know about retirement account is that you cannot withdraw until 59 and a half years, until you're that old. If you withdraw from it, there is a penalty. Although there are some provisions like hardship withdrawal, like owning your first home, that lets you like borrow from it and then you can take back. But besides that, you cannot take from it. Otherwise, there will be 10% penalty. One thing to also note is that when you leave a company, you have different options. There are some companies that will allow you to leave your retirement account there. There are some that will not allow you. But even if you leave your retirement account there, it might not be the best option. There are different options. You can roll over into your current company's account if they allow you. There's something. Sometimes it may not be allowed, but if they allow you, you can do that. Another option is to roll it into an IRA. But maybe some other time we'll find time to talk more about a retirement account. Then the other thing is to develop smart tax strategies. You can be sure that Uncle Sam will always ask for its own share. When you invest, you are going to pay taxes on your investment. Now, having said that, there's this concept of realized gain and unrealized gain. You invest $100. You look at your portfolio 6 months later, your $100 has become $150. You will still, that doesn't mean you are going to pay interest on it yet. Taxes rather. Your gain, the gain that you have right now is what is called unrealized gain. What it means is that if you are yet to sell your investment, you don't pay taxes. It's only when, and I'm talking about capital gain right now. On capital gain, you don't pay taxes on capital gain until you actually sell your investment. So if you keep it for 5 years, 10 years, it keeps growing, you don't pay any interest on it. I mean, any taxes. I don't know why I keep saying interest. Having said that, there are things, there are some incomes that you pay taxes on. When you, if you buy dividend stocks and they give you dividends, every year you pay taxes on that. If you have interest income, let's say you invest in CDs, anytime you earn interest like that, you pay taxes on it. But having said that, there are smart strategies to actually reduce taxes. One of them is tax loss harvesting. With tax loss harvesting, you can reduce the taxes that you pay on the investment, on your investment. Not only that, you can actually also reduce your taxable income by up to $3,000 every year. And one good thing about it is that you can also carry it over to another year. So taxless harvesting basically means that you are intentionally, take that word, I mean, no, underline that word, intentionally selling something at a loss. When I first started investing, one thing I vowed was never to sell anything at a loss. I decided that, okay, even if the value of it, of the stock goes down, I will not sell it. I will wait until it comes back up. That may not be a smart strategy. There are times that you intentionally sell something at a loss to offset the gain that you have in another investment, or to even reduce your ordinary income from your regular job. You can reduce it by up to 3,000. But again, we can talk more about this some other time. Oh, one more thing I need to say about this is that every investment, the tax implication of every investment is different. For example, the tax implication of ETF is different from tax implication of mutual fund. For me, for my clients, and I'm going to talk about my company later. I have clients that I invest for, and I have never bought mutual funds for any one of them. That doesn't mean you should always avoid mutual funds. I have mutual funds for my own personal account, but I'm personalizing investment for my clients. And I still, for all of my clients right now, I've not seen a need to buy mutual funds for them, because mutual fund is not as tax efficient as regular stocks, and ETFs. Another thing is the asset class. The tax implication of, let's say, precious metals, let's say cryptos, stamps, and some other things is different from the tax implication of regular stocks. So before you invest in something, look at the tax implication and look at the ways you can reduce your taxes. Now, protecting your investment. One of the issues that discourage people from investing is that maybe they invested in a specific stock at one time or the other. The price of the stock went down, and they thought, oh, I've lost money, and they never invest again. There are ways you can actually protect your investment. A good investor has risk management strategies to make sure that you protect your investment and you don't incur losses, or at least to reduce the losses you can get from that investment. Now, having said that, you always have to strike a balance between risk and return. If you want more return, you have to take more risk. If you want to protect your investment, then you will likely get a lower return from that investment. Now, here in this image, I have different asset classes. The one that has the lowest risk and the lowest return is the cash. Put your distant cash and CDs. Put your money in the bank, right? The probability of losing the money is low. That doesn't mean you cannot lose the money. That's why it's not the risk is not zero. It is possible for you to lose the money in your account. First of all, I already talked about inflation. The value is going down. But besides that, if you put your money in a bank that is not protected by FDIC, FDIC stands for Federal Deposit Insurance Corporation. If the money is not insured by FDIC and the bank fails, you are going to lose all your money. Even if your money is protected by insured by FDIC, there's a limit. The limit is for every account type, and for every bank, your money is insured up to 250,000. Anything more than that, the bank fails, you lose the money. So there's really nothing that is risk-free, but the risk of an asset class can be lower than another asset. So Because the risk with cash and CDs are low, the return is also low. Look at bonds, a little higher risk, but also a little low higher return. But you have balanced funds, meaning like some money mutual funds and some other things that are more balanced, that have different asset mix of asset classes. They are less risky, but they have lower return. Then you go to large cap stocks, small cap stocks, international stock sector, and alternatives. Those are very, very alternatives. Part of alternatives are like bitcoins, that are like, okay, maybe some kind of real estate and things like that. They have high returns, but they also have high risk. So before you choose an asset class, look at the risk. As you are looking at the potential return, look at the risk and determine that, okay, are you okay with the risk? Like I mentioned earlier, I'm not okay with the risk for cryptos. Look at Bitcoin. Bitcoin, maybe around November or thereabout, it was about 120,000. Now it's about 70,000. Imagine having like 10 10 of it, and look at how much money you would have lost if you bought in November and now you're trying to sell it. So again, that doesn't mean you should not invest in it. Just be sure that you are okay with the volatility with it, and then yeah, you can get the return. So it's good to take note of that. Another thing you can do to manage risk is to diversify. Rather than putting all your money, let's say, in a sector fund or an international stock, you can put some in international stock, some in balanced fund, some in CDs. That is called diversification. So if something happens and one asset class has lower return, maybe the other one will have as higher return. There are actually asset classes that are negatively correlated, meaning the price of one goes up, the price of another one comes down. So you can use that strategy. But diversification is not only about the asset class. Within the same asset class, having multiple stocks of multiple companies can also be a form of diversification. Having even within the same asset class, different industries, different sectors, that's another method of diversification. One other thing is setting stops. I won't be able to go into details. There are things called stop limits, stop loss, and all of those things. What it basically does is that if you invest in a particular company, let's say Amazon, for instance, you can set stops such that anytime the price of that stock begins to go down, your brokerage accounts, the brokerage firm will automatically sell it, right? So that you don't incur too much losses. But that has its own pros and cons as well. So take note of that. Maybe maybe one of these days we can talk more about setting stops, or I can make a video on it. Now, setting realistic financial goals. It's always good to give your money a purpose. Have a purpose for which you are investing. Like for me now, I have multiple brokerage accounts, each one for a purpose. I told you earlier that I had one for my car. I have another one for my mortgage. I have another one for different things. I have an account for my son, right? So you should have a target. You should know that, okay, what is it that you want to do with this money? What is the time horizon? What is the interest rate that you are trying to get? Or the return that you are trying to get. That may determine the asset class you are going to invest in. So you should have goal. You should have short-term goal. You should have long-term goal. But make sure that you are realistic. You don't want to say, oh, I'm investing this money and then I'm expecting 30% return, 50% return. That's not realistic. So make sure that your goal is realistic, it's achievable. There's this acronym called SMART. It should be specific, it should be measurable, it should be achievable, it should be realistic, each time bound. So when you set goals, that will help you in determining a lot of things about your investment. And it's also good to check back on your goals, see how much of it you've achieved, and see if there's a need to adjust it. Now, let me show you, asset classes do not perform the same way. And that can guide you in determining what to invest in. So I have this chart here. How much would $100 invested in 1960 be worth in 2026? If you put your money in savings account, most savings accounts will give you a return of less than 1%. Let's assume that you have high yield savings account. If you have high yield savings account, maybe you get like 3%, 3.5%. If it's an online bank, maybe 4%. But even with that, if you invested 100,000 in 1960, in 2026, you will only have 2,000. If you say, okay, I want to take more risk, you invest in government bond, you have 3,200. You invest in corporate bond, 4,500. You invest in gold, 8,500. You invest in real estate, you have 12,000. But look at this, $100. That, and I'm talking about, you just put the $100 there. You don't bother to add to it. Just put it there and forget it, right? You will have $74,000 invested by just putting $100 between 1960 and now today. You have 74,000. Look at the difference. 74,000, 2,000. That is what so many people miss when they just put their money in savings accounts. So this is really, really important, and this is the reason I'm always an ambassador for investing in stocks. I don't know what else you can do that would take your $100 from 1960 to 74,000. This is assuming an annual rate of 10%, which is like the average return between 1960 and 2026. Now, this is one thing I always tell my clients or anybody I'm talking to. There are 3 things that would determine your success in the stock market. I've seen a lot of people who invested in the stock market at one time or the other, and maybe they lost money, or maybe they just got discouraged or something. Let me tell you, you can then lose money in the stock market. It is possible. It is possible for you to invest in a stock right now and it becomes worthless. It becomes zero. I have at least 3 stocks I invested in and they become zero. I cannot recover it again. But are there ways that you can actually make money in the stock market? Yes. So I have come up with 3 pillars of successful investing. What to buy, when to buy, and when to sell. Let me tell you, if you get one of these 3 wrong, the probability of being successful is very low. What to buy? If you buy the wrong thing, you buy the wrong stock. There are people that maybe they heard that, oh, this stock is, the price of this specific stock is up, buy, and they just rush into it without doing their due diligence. I have some people that we share information about investing and all of those things. There was a time somebody told me that, oh, this stock is good investing in. And I asked, have you actually done the research on it? Have you looked at the trend? And the 2 people that were there, the person that and one other person, they just laughed. They just burst into laughter. I was like, no, I'm not just going to invest because you tell me to do so. That's one thing that many people get wrong. Just because somebody tells them to go invest, they don't know whether the person on their due diligence, they just go invest. And that could lead to loss. If you don't do, for me, before I invest, I do my due diligence. There are 2 things I do. I do fundamental analysis. I look at the fundamentals of the company. I look at, like, okay, maybe the management, maybe the cash flow, some other financial ratios of the company. Some other time, rather than doing fundamental analysis, I do technical analysis. And technical analysis does not necessarily have to be deep. It can be as simple as just looking at the trend. I don't buy stock without looking at the trend. Even if something that, okay, I know it's a good company, I know even if it is doing, even if the fundamentals are good, I still look at the trend. So if you make the mistake of buying something that you have not, without doing due diligence, you can lose your money. Now, you've done due diligence. Okay, this is a good stock. This might not necessarily be a good time to buy. You have to look for a good time to buy. For example, a year ago, Spotify was doing well. Spotify is no longer doing well right now. So it was good a year ago. It's still a good stock, but if you need your money in the next 1 year, years, I would not invest my money in Spotify stock. Even Microsoft for some time has not been doing well. So when to buy is really important. Then lastly, when to sell. This is an issue with so many people. So many people sell at the wrong time. The fact that the price of the stock you have invested in has dropped does not necessarily mean you should sell it now. Let me share an example. When I started investing, like I said earlier, I have multiple accounts. There was an account where I took a lot of risks and I bought EVs. You know, there were times during Biden administration that they were saying buying EVs. The people were saying USPS would not start using EVs. So I bought a lot of EV stocks and I took a lot of risks. At the time in that investment account, I had a loss of more than $1,000 in that account. If I just decided to sell everything, I'll walk away with the loss. But can you imagine that today that account that is negative is now positive? So the fact that the price of something or something has gone down does not necessarily mean you should sell it. Anything can happen. It could be due to anything. Look at now, the stock market has not been doing well for the past few weeks because of the war in Iran. Tomorrow the war ends, you can see a jump. Look at last year when the tariff issue happened, right? There was a jump. So anyway, let me to cut the long, not to take too much of your time on this slide. It's important to get those three right. If you miss one of them, you might not be successful. That's why it's good that you learn to invest. You don't just go into it, you do the due diligence. You learn, you take time to learn, and then you go into it. And if you don't have the necessary knowledge, you don't have the time to be able to do the due diligence, maybe it's better for you to hire an advisor. That takes me to Ivorian Financial. To the glory of God, when it comes to investing, God has helped me. I've made a lot of returns on that. And that's why I'm always an ambassador. I'm always encouraging people that invest. And I have the passion. I have passion for it. I always talk about it. And that's one of the things that drove me into helping people. People who don't actually have enough knowledge, people who don't have the time to do their due diligence. I help them to invest. Created Ivorian Financial, which is a stewardship-focused registered investment advisor. When I mean registered investment advisor, I mean that my company is actually registered. Before I could start the company, I actually had to take exam and I had to register, and they vetted some of my my documents and so many other things before I was approved. The mission is to align finances with values, clarity, care, and generosity. We help people with personalized things. We help people to invest on what they care about. And obviously, I'm the founder and the principal advisor. Now, at Ivorian, what are the services we offer? Investment management. We could be discretionary or non-discretionary. Discretionary is you give me the power to be able to invest in anything I think is right for you based on your client profile, your profile that I obtained from you. I have the liberty to invest for you. Non-discretionary is that I just tell you what to invest in. Risk is on you. You go invest for yourself. When it's time to buy, you buy. When it's time to sell, you sell. Meanwhile, I don't collect money from people. I actually have um what's it called? I have an arrangement with Schwab, which is the largest brokerage firm in the world. You open an account with Schwab. From my own advisor account, I'm able to get into your account and trade for you, but I cannot take money out of your account. The other thing we do is financial planning. It's not just enough to invest. How can you be sure that you are not going to run out of money in retirement? How can you be sure that the money you are putting in your retirement every year or every month is enough for you? How can you be sure that when your children grow up and they go to college, that you have enough money to pay their tuition? You create goals. You want to go on vacation. You set goals, right? You want to go on vacation. You want to get a house. How can you be sure that you have enough money to do that? How can you be sure you have enough insurance? You are managing your debt very well. So we do a comprehensive financial plan. We take a holistic look at your finances to determine the things you need to change, the things you need to start doing, the things you need to stop doing so that you can achieve financial freedom. Then, obviously, we do educational seminars like this. We offer tools like I'm doing today. If you belong to an organization and you'd like me to come and talk to them, I'll be glad to do so as well. So, I'd like to thank everybody for attending today's session. We'll look at the possibility of doing this more often. Some of the things that I had to rush over, maybe we'll take more time to talk about them. Maybe one time we'll talk about stop losses, how to protect your investment. I actually have a video. If you go, there was a seminar I did on risk management. Go on my YouTube channel, use one on risk management. But maybe in subsequent times, we'll dive deeper rather into some of these things that I've talked about. Maybe in another session, we'll actually practice a demo like, okay, how to trade, show you how to trade and some other things. But anyway, thank you for joining today. And in the next few minutes, I'll entertain because for meanwhile, yeah, if you please feel free to look at my website. You can reach out to us, and I have a QR code here. If you'd like to learn more, I can have a free session with you. Tell you more about it. You can do that, or you can go on my website. You can reach out on phone. You can check my YouTube channel. So in the next few minutes, if anybody has any question, I'll be happy to answer. Any question? Or your thoughts? You can not just question, you can share thoughts as well. Feel free to unmute yourself or you can put it in the chat.
So I did have a question. I know you said something about like AI taking notes on the meeting. Would those notes be able to be accessed like elsewhere?
Oh, those notes are just my own personal use. Actually, I set up those notes for all of. I did not even intend this specific meeting. I set them for every meeting I scheduled. So that was added. You will not have access to them, but I'm going to put this recording on my YouTube channel. And if you want to go back and watch it again, you can do that. But also, if you need help with anything, you have anything that is not clear, feel free to reach out to me. Phone, email, I'll be able to answer. But yeah, you won't have access. No, you won't have access to the notes.
Sounds good. And thank you again for a great session today.
You're welcome.
All right,
Any other questions?
Ilori, for the enlightenment, and I think this will be my second time joining your session. Yeah, So today I would like to know, because you talk about if we invest with you, you help us open a Schwab account, right?
Yeah.
So we don't pray any evil happens to you, because we know that your our investment counts with you. So is there, in case of any unforeseen event, we've known you, we some of us are friends, some are, we trust you. So but in case of any unforeseen event, so are you the only one that can access the account, or is there any other person that is involved? Because we know that without you we won't be able to withdraw or do anything with the Schwab account. So I just want to be clear that, okay, you as Mr. Ilori, you are investing on our behalf. So, and we know that we're going to have a Schwab account. So, but apart from you, is there any company members that have access, or only you can operate the account? I don't know if that question makes sense anyways.
Yeah, it does make sense. It's a valid question, yeah. So now, if you remember, I said earlier that I don't touch your money. I will not have access to your money. Your money will be in your account. I cannot take your money. And you can log in. You're going to have your account with Sharp, right? Log in as many times as you want in a day. You see your investment, you see how it's growing, and you get a quarterly report from Schwab to tell you how your investment is performing. If there's a need to get it monthly, I can make that happen, but the default is quarterly, right? So, in short, your account, you own your account. I don't own it, and I cannot withdraw from it at all. So the relationship I have with Schwab is such that I have the ability to trade for you, but I cannot withdraw from your account. To even get my fee, Schwab takes the money, takes my fee that we've all agreed on, we've signed. Schwab takes my fee for your account and they give it to me. I cannot get it myself. So now, if anything happens, let's say I'm out of the country or for whatever reason, and you need access to your account, you can get the account. Now, having said that, there's something I place on your account. I want a situation where I go buy certain stocks for you, and then tomorrow, maybe because of the war or something, you go sell it when it's not time to sell. Remember the three pillars: what to buy, when to sell. I don't want you to sell when you are not supposed to sell. I will put, when you have an account with me, I will put some like a limitation on your account such that before you can sell, you read it to me first. If it is cash that is lying in your account, you can withdraw it without talking to me. But if it is an investment, if I've already invested in an asset for you, before you can sell it, you let me know first. I put that limit in your account. Having said that, if for whatever reason you are not able to reach out to me, really need to liquidate your account, you can do so by reaching out to Schwab, and they will lift the limit I put on your account, and you can sell it without any issue. Does that make sense?
Exactly. Thank you.
You're welcome. Any other questions? Any thoughts?
Um, you mentioned, thank you so much for a really informative webinar. I have a question. So just like you said, there's a war going on, potentially multiple wars. Do you think it's a good time to start? I know you mentioned, there's a, time horizon, and the fact that, the earlier you start investing, the better. But you also mentioned that there's a time to buy and a time not to, or a time to invest and a time not to invest. So with all that's going on, do you think now is a good time to start investing? Or should we maybe wait until the economy hopefully gets better?
Okay, that's a good question, and I'm trying to look for an analogy. Let's say there's something you buy often from, let's say, Walmart, for instance. Let's say the regular price is $100, and you walk into Walmart and you see that they have sales going on and the price is now $60. What do you do? Do you sell what you already have, or do you only buy one, or do you buy more? An average person will buy more, right? Let's say every week you always buy 1 unit of that product. But because there's a sale, they reduce the price from $100 to $60. Rather than buying one, maybe you're going to buy 10, right?
Yes, for sure. Yes.
Yeah. That's the same thing when it comes to investment. People make the mistake of when the market is not going well, irrespective of what caused it, maybe tariff, maybe war, maybe just general issues. People sell. No, don't do that. But rather than selling, if you have cash lying around, buy more. I can tell you with this war, I'm still buying. Yes, this week, I believe every single, maybe not every day, at least this week that we just ended, at least out of the 5 days, I still invested at least 3 days. I still bought stocks at least 3 days. Every day I have my application open and I invest. So what I will recommend is that this is actually a good time to buy because the prices of most stocks have gone down and you can buy them cheaper. The war could end tomorrow. If you remember April 2025, there was the government, the administration announced tariff, and one day they just lifted the tariff. The price of before they lifted it, the price already went down. The day they lifted the tariff, everything just shot up. You don't want to miss that. So my advice is this is a good time to actually invest money. Yeah. Any other question, thoughts? Anything? Feel free.
All
Unmute
right.
yourself or
So
you can.
lastly, your operation, is it limited to these states? Can you operate globally, or you have a restriction
I
just
do
here in the US?
I do have restrictions. For instance, I cannot like with so here's the thing. The company itself is not limited. I can go register in any company, I mean in any country and operate there. What is limited is that, like I told you, I have a custodian shop that you open an account with Schwab. I help you to open an account with Schwab. Schwab does not accept people from certain countries. Unfortunately, our dearly beloved countries is one of such countries. What's it called? Nigeria, Ghana. If you're from Nigeria, from Ghana, you cannot have an account with Schwab. If you're from South Africa, you can. So yeah, my company itself does not have any limitation. I can work anywhere, but my custodian only does not accept people from certain countries.
Sorry, to clarify, do you mean people who are currently living in those countries or people who are from those countries?
People who are citizens, like, okay, I'm a Nigerian, I'm also an American, I can
Mm-hmm.
invest. If I was only a Nigerian and I'm not an American and I don't live in America, I will not be able to invest. So if you
Okay.
reside in America, irrespective of your citizenship status, you can invest. Or
Okay.
if you reside in another country that a shop allows, you can invest. But if you reside in Nigeria, Ghana, and you are not a citizen of another country that SHAP allows, no, you cannot invest in SHAP. But some other, you can invest with some other brokerage firms that may allow it.
Sorry for going back and forth on that. Take for instance, I am a Nigerian. Right now, I'm in the US. Later in the years, maybe I traveled back home, and for sometimes maybe 5, 6 years, I still remain back home in Nigeria. So you said during those period, I wouldn't be able to access or do any operation with my accounts based on what you just said now.
So if you have lived in America before, you have social security and you used American address to sign up. If for any reason, let's say you go back to live in Nigeria for 2 years, as long as you are still using your American address for correspondence, you can still continue to invest. More these days, everything is electronic now. They are not even your report and everything. They are not going to send it unless you request. They are not going to send it to that address anyway. So if you don't change your address and you are still using that social security number, yeah, you can still continue to invest. But for somebody that is using Nigerian address and does not have social security number, no, you will not be able to invest. Which sure, maybe other brokerage firms will let you. I've not checked with other brokerage firms because I don't use them. Okay, any last minute question is past 12. Last minute question before we end the session or thoughts? Okay, everyone, once again, thank you for um, joining. We have your registration details. If you decide to do this again, we will reach out to you and then yeah, you'll be able to join. I hope you all enjoyed today's session. I hope you took one thing or the other, but I don't want you to just leave this session and go back without investing. You don't necessarily have to use me. You can invest yourself or you can use somebody else. But I want you to start from, for somebody that is not investing, I want this to be like a turning point. I want today to be the day you actually you start take a step. Don't let this seminar be a waste of time for you and for me. Please, whether you use me or you do it yourself, please make sure you take note and start investing. And then yeah, if you need help, please feel free to reach out again. You can schedule a free session with me. You can reach out to me. You can watch some videos on my YouTube channel. All right. Thank you, everyone. Yeah. Have a good rest of your weekend. Bye.
Thank you so much.
You're welcome. Thanks. Bye.
Thank you. Bye.
Thank you.
Bye. Bye.